What's up, you guys? I'm Dan, this is Frugal Not Cheap, and today we're talking about how to make a budget. In the previous video, we talked about how to get started saving and how a budget could be a helpful tool to see how much you could start putting away. But I also noted that a budget could be a stumbling block for some people, and that for those it would make more sense just to identify a small amount that they could start putting away consistently instead. For everyone else, let's talk about how to make a budget today. It's pretty straightforward and extremely useful. Okay, so what is a budget? It's basically a plan for your spending and your income over a period of time, and this plan can help us do a few things. One, it lets us know what we have to work with, our income. Two, it lets us know how we've been using it by category. And three, it allows us to tweak accordingly in order to reach our financial goals. In other words, a budget helps us to chart a path towards our goals. It's hard to get there if we're going blind. Okay, so what time period should we look at? I suggest looking at an annual budget. For the following reason. A lot of the people that I worked with over the years that were in the hardest financial straits tended to be people that thought about finances in the very, very short term, even weekly. The problem with this nearsighted kind of view is it makes you more likely to optimize for the short run rather than the long run, of course. So, for instance, you might buy just enough of some item at the grocery store rather than buying in bulk where you could save more. And it also, when you're looking at these short time frames, means that you're not looking at the long term, and so you're less likely to even start putting away the savings because you're thinking in terms of weeks and not in terms of years. In other words, thinking in these short time frames may make it harder for you to lay and enact plans for the future. It'll be more helpful if we think in terms of years, and that's really the time frame that long-term financial planning takes place in. Alright, let's get started with our annual budget. First, let's look at the income side of things. We need to know what we're working with. Then we'll take a look and see how we've been allocating those resources, and then finally we'll be able to look at both these things in order to set achievable goals. To keep things simple, today we'll use the example of a single adult person here in the United States. The median personal or individual income here in the US was $35,977 last year. Let's call that $36,000. Now, because everyone's situation with pre- and post-tax deductions is going to be different, we're just going to keep things simple. And anyway, once you have the main idea of how this works, you can make those adjustments to fit your particular situation. So to simplify, we're just going to look at take-home pay, that's going to be income after taxes, and health insurance. Let's do health insurance first since it's tax deductible. The average annual premium for an individual adult in 2019 was $7,188, of which employers picked up 71%. That leaves 29% of $7,188, or $2,084.52 as our cost. Now let's look at income. In the US, we have a marginal tax rate system. Pay close attention here as a lot of people have a misconception. The bottom tax rate for 2021 is 10%, then we have a 12% bracket, and we also have a 22% bracket. Now let's say you are right at the top of the 12% bracket. When you get a raise and now your income is up into the 22% bracket, that doesn't mean you're all of a sudden going to be paying 22% taxes on all of your income. You only pay the 22% on the part of your income that falls into that bracket. I repeat, the tax rate does not apply to all of your income, only the portion of your income that falls into that tax bracket. Otherwise, you'd be heavily penalized for making more income, and it would make no sense. Again, we're going to keep things simple, so we'll look at an individual that's going to take the standard deduction. This is a standard amount that anyone can take right off the top of their income when they file their taxes, and in fact, during the Trump administration, this standard deduction was raised significantly to $12,550 for next year, making it much less likely that people would benefit from itemizing anyway. So our taxable income is $36,000. Less the $12,550 deduction leaves us with $23,450. But then we also have the $2,084.52 that we spend on health insurance, which is also tax deductible. Now we'll look at those marginal tax brackets. We pay 10% on the first $9,950 or $995. Then we pay 12% on any income between $9,950 and $40,525. For us, that's $23,450 minus $9,950 minus $2,084.52 for the health insurance which is $11,415.48. And we pay 12% on that, which is $1,369.86. Our federal income tax bill then is the $995 for the 10% bracket, plus $1,136.86 for the 12% bracket, or $2,364.86. And so our take-home pay after taxes and insurance is the $36,000 minus that, which is $31,550.62. Okay, so now we know how much we've got to work with. Let's see how we've been allocating this take-home pay. The biggest item, of course, will be housing. We're using a single person here, and we'll be a little bit spendy pants and say that they're renting their own apartment. Of course, a great way to cut down on that cost could be to have roommates, especially if you're younger. That might be a more reasonable lifestyle. The median rent for a one-bedroom apartment in 2018 was $1,078 a month, or just under $13,000 a year. The next biggest expense is probably transportation. Here, people are often pretty spendy pants. Personally, I think buying a reliable used car that's about 5 years old, say made by Honda or Toyota or something like that, something very sturdy and reliable, is about the sweet spot because you're having someone else pay for all the depreciation. In fact, cars tend to lose about 45 to 55% of their value. These better made cars will hold their value a little bit better, but still by about the 5-year mark, they should be roughly about half off the new price. Additionally, unless you're able to get an interest rate that's very low, say 4% or lower, then borrowing money to get the vehicle is something I personally wouldn't do. The norm in the US is to borrow money for a car though, and the average car payment is $393 a month or $4,716 a year. Ouch! Then we have to insure the thing. And here's another place where having a slightly used older car is great because it costs less to insure. You might not need to have comprehensive coverage. Certainly you won't have a loan that requires you to have comprehensive coverage. And on top of that, as long as you have enough cash set aside to replace the car if you needed to, then you really don't need it. You can just go with liability. But we're starting with the average spendy pants person here, so we're going to go with the average full coverage insurance cost, which is a premium of $1,738 a year. As if that's not enough, we still need to pay for gasoline to get the car going, and then we also need to pay for maintenance, service, and parts. We'll go with $1,000 a year on gas and $500 a year on gas and service. Altogether, that's just under $8,000 a year on transport. So definitely a very large category and nearly as big as rent once you really add up all the expenses. Then we've got groceries, utilities, mobile phone, clothing, and entertainment. In our budget here, I think we've been fairly generous with $150 a month for restaurants and $80 a month on entertainment. Even with all this, we still have $3,390.62 left over to save each year. And with tweaks, we could improve on that. I'm sharing this budget template with you, and I've left a lot of rows blank so that you can customize and add in your own expenses that might be specific to you. Maybe you have a gym membership or something like that, and you can find that budget in the link in the description below. Now, you might be thinking that your income and spending are pretty similar to what's going on in this budget, but you don't have that $3,000 left over at the end of the year. Why is that? Well, it might be because of all the little things that add up. Unless you're really keeping track, it's quite easy to fritter away thousands of dollars on this and that. So, along with making this budget, of course, which is our plan, we also need to stick to that plan, which is to track our spending. If you don't track your spending, then you won't know whether or not you're sticking with your plan. After a while of doing this, it gets to be a little bit easier because, well, you kind of run into a habit and your regular spending is spending that's going to keep you within that budget because you just don't do things that put you outside of your budget. And because of that, it doesn't feel restrictive, at least not to me. I hope this video helps you put together a yearly plan for your finances and helps you to set some goals that you can achieve. Thanks for watching. If you like this video, hit the like button. If you'd like to see more videos about saving, investing, frugality, finance, and financial independence, hit the subscribe button. Ring the notification bell icon if you'd like to know when new videos are posted. Do you have any tips about making a budget? Let us know in the comments below. Again, I hope you liked this video. Thanks very much for watching, and I'll see you in the next one.